Hey there, friends. Thank you, Lo-Fi, as always, for the wonderful bumper music. Hope everybody's good today. Okay. So, yeah, good afternoon or good evening, good morning, wherever you happen to be right now. So what's happening right now? It's a fun and wild market as always. We have a decent amount to cover today. Not a ton, though. I think we'll have ample room for chatting. The TMDC was just deliberating about our collateralized debt via Rari. If you guys followed along with crypto over the weekend, it's been a crazy weekend. Solana went down, which honestly wasn't too surprising. Solana is more of a centralized blockchain, but Rari's Fuse product was hacked. $80 million was absconded with. An important thing to note, though, is that didn't directly affect ShapeShift because none of our Fox was vulnerable in that case. However, we do use Rari for funding various things, and especially in the past before we had our Olympus bond. So we were just having an interesting discussion about paying down some of that debt in order to save on our debt service costs. Let's see, I'm getting pinged here. Okay. So, yeah, what else is up? I don't know who listened. I think a lot of people here probably listened to Michael's Foxchain call. And I don't know about you guys, but I'm super excited about this. It introduces a new reason why you would want to hold Fox. When I say I'm excited, it means both from a tokenomics perspective and a making the world better perspective. Having decentralized node infrastructure is such an important piece of building just more decentralized tech. And this is what we aim to do with Foxchain. From a tokenomics perspective, it's super interesting. In case you didn't listen to the call, we kind of the idea right now is that this chain, this new Fox chain, could actually have its own token, whereas previously the idea was we would just peg the existing Fox token over to this Cosmos zone. So this introduces some interesting dynamics. I think it's actually a good idea. One thing that I think is a non-starter would be turning the Fox token itself into an inflationary token. I think, one of the strengths that we have is just not being inflationary. And, eventually, as we combine that with efforts to have our own protocol and liquidity, that's powerful. We're not relying on the quick and easy fix of just deploying inflationary emissions or rewards to incentivize various DeFi activity. So in terms of updates, you guys may have seen the TMDC proposal put up by Rotorless has passed. That officially gives the TMDC another 16 million Fox allocation to work with, which is very cool. Let's see. The first thing that we'll do with that is Hedgie. This was actually pre-approved by the TMDC, but we will be selling up to $500,000 worth of Fox via via Hedgie, which is a newer protocol. That starts on Thursday. It's unclear how quickly we'll be able to sell that Fox. This is a kind of a newer product, and this is a newer effort on our part. I'm hoping that it goes well because one very important difference of Hedgie relative to like the Olympus bonds that have been working well so far for us is those Olympus bonds have a very short time lock period. Up until recently, it's only been 7 days. And it's an 18-month time lock on Fox for anybody that buys Fox on a discount via Hedgie. So, that really pushes things out in terms of that sell pressure. And, but again, the jury's out, so we'll have to see how demand goes on that. And there's some extra nuance in terms of those Olympus bonds as well that we'll cover shortly. In terms of VFox, so you guys may have seen, we had some super exciting news recently. VFox made its first strategic allocation. This was in Elastic Swap. And this felt like such a natural fit for us because Elastic Swap will facilitate basically an AMM for Foxy, which of course is a rebasing token. It's one of those things that might not occur to you unless you dig into kind of advanced DeFi and really you work with rebasing tokens. But existing AMMs don't really have support to handle rebasing, just the nature of how they work and how they effectively grow in your account. So Elastic Swap has done some really cool work behind the scenes. They're currently deployed on Avalanche. They'll be moving to mainnet, or I should say ETH mainnet. And great team. Of course, Ocean is part of that team, and he's also a complete rock star here at the DAO. We were able to just get a better sense of their own plans, and it feels like a wonderful fit. So that was very exciting to move forward on that. You can read more details about that on the ShapeShift blog and the Elastic Swap post about it. VFox continues to evaluate different potential ideas. We have a allocation of $1 million, and we've only used a small fraction of that so far, so full steam ahead. And thanks, of course, to John and Willie for being part of those efforts, and to the Elastic Swap team for being so cool. Let's see here. So one of those nuances I wanted to bring up with respect to the USDC to Fox bonds is, and props to Josh for coming up with this idea. The time lock on those has been 7 days, which of course, that does prevent people from doing, executing strategies where they'd immediately dump Fox and enjoy their discount. It wouldn't really work any other way. But in the scheme of things, it is relatively short, just a week time lock. So the thought was, well, what if we could just make the term longer? And Josh, sort of put this idea forward, and we went to Olympus, and they were actually, based on what they said, it's like, okay, we can just raise that to whatever. I don't know if it's arbitrary, but effectively, we were able to just kind of say we want to do 28 days. So this is a new experiment. All things considered equal, it would be much more preferable to be selling with this 28-day period. The big question, though, is will demand remain the same, or will it drop because of the 28 days? You got to get in the head of the people, the heads of the people using this product, using this bond. Market data will give us that sense of what's going on. There's actually one additional challenge, though, to getting that data right now, and we were talking about this earlier in the Tokenomics channel, is right now that there's a negative discount for the bonds. This is a fluctuation that happens over time. It's a normal fluctuation. So we can't, even though there's no demand for the bond right now at 28 days, it's far too early to say, this strategy is not working and we need to bring that time back. So let's see, John, you may not be available right now. I'm going to invite you up on stage if you are, to chat a little bit more about that. If not, we can, hey, there you are. Hey. You're on stage, however, we cannot hear you.
I know. All right. How about now?
Yes. Check
All
1,
right.
2.
Had to read my Discord. Okay. Happy to chat about this a little bit. So as you just mentioned, we just made that change to 28 days of vesting on the Fox bonds. And in theory, hopefully this should help align that people that want to actually buy those Fox bonds are people that want to hold Fox over the long term, because they're obviously going to take more price risk than over 7 days. But one of the things we want to watch for is whether that dries up the demand, which is also possible, and or if our discounts start getting too heavy as a result of that. So it's too early to make any assumptions right now with the kind of downward macro trend. Our Fox bonds have not even gone positive discount since we changed that. That's what I'm looking right now. Yeah, they're still at a premium. So we're going to be just watching that over the next, days, weeks as that goes positive again and seeing just where that demand falls. And we may have to make adjustments based on what that impacts, but we honestly just don't know yet.
Yeah, it's going to be interesting to see. It seems possible, and looks like my room's a little bit echoey. I apologize if it sounds like I'm in a cave. My room in here is just naturally echoey. Sometimes I'll put some ad hoc soundproofing in it, but apologies if it sounds less than professional in here. Yeah, it seems like demand might be somewhat less just because it's a longer time lock period, but also considering the discount fluctuates too, it's going to be really interesting to see what happens there. So again, if we can have those longer time periods, that's highly desirable, and we'll see what happens there. And thanks to everybody on the bond committee for really delving into the finer points of all this stuff.
Yeah, absolutely. I think it's a good experiment, and I think it's worth just mentioning that the TMDC and the bond committee both are watching these things closely and considering other options. I think there's definitely talk about what we can do to reduce those emissions in the near future, especially once Rari comes back and we have a little bit more in our tool set. But those are all things we're considering, and the additional vesting time at least buys us a little time to find the right plan.
Absolutely. Knowing that you may have a conflict or something to do during this hour, John, before you jump off stage, is there anything else that you wanted to broach as long as you're up here on stage?
No, not specifically. And I just might be out of pocket for 10 or 15 minutes, depending on timing of something coming here. But no, not specifically at this moment.
Awesome. Cool. Thanks. Well, if you are able to and you have something that pops in your head, don't hesitate to jump back up.
Yeah, appreciate that. I'm not usually shy to chat when I have something to say.
Cool. Let's see. PTT says in the chat, I noticed you haven't been at the ops sprint. So I need to be honest, I'm a little bit mortified at this, guys. I have a personal calendar that I'm migrating over to a different email that's specific to my own, or to tokenomics. My calendar has not been synced, thus the weekly ops was not on my calendar, and thus I have completely forgotten to do the past 2 weeks. I'm very mortified at this. I apologize for anybody that was sort of like, where the hell is Kent? It just simply was not on my calendar, and that is absolutely retarded on my part. So I will certainly be there next Monday. I don't know where my head was at on that one. If anybody has any questions about what's going on, please always, ping me directly or jump into the tokenomics chat. And I apologize for the miscommunication or lack of communication there. So let's see here. We actually have a special guest today, and this presentation will go perhaps a little bit longer than the standard 15 minutes, but that's okay because we have enough time. So I believe that we might have about 20 minutes for a presentation, followed by Q&A. After that, I think we'll even have additional time for more chatting and just talking about whatever we want today in tokenomics land. But today's speaker is going to be Mr. from Sense Finance in the house, or perhaps maybe other speakers as well from Sense. Let's see. I'm looking for you in the audience, Mr. Oh, there we go. Hey there. Welcome to the DAO stage.
Hi. Honored. Is my audio working and reasonable sounding?
Yes, sounds good.
Is there a way for me to share my screen and actually put together a deck for this?
Yes, there is. So we have a Zoom link that anybody can share to. If you jump into the DAO stage chat, there is, here, I'll grab the link here and repost it. Yeah, Psychedelic just posted it. So if you jump into that Zoom, you can share from that, that link right there.
Yeah, let's see. All right, I'm in here. Are y'all popping in? Can you see me? I actually turned my camera on. I feel like it's easier to understand when you can see me when I'm explaining concepts. Let me work on getting this share working. I guess we're all set and you can hear me. I'm doing audio through the Discord and video through the Zoom. I'm looking at the chat here if anyone wants to give me a thumbs up or something. I can see you. All right, sweet.
Looks good.
All right, so quick introduction. We are Sense. We build permissionless DeFi infrastructure, and we're here to talk to you about a DUX, or a DAO Upside Community Sale, which is a DAO financing tool that we invented that's enabled by some of these contracts that we've created that are permissionless. So you can do this with or without us once we explain to you how it works. Quick introduction of myself. I am Alan. I am the head of growth and strategy at Sense. You can find me at Mr. or Mr. Keegan on most things. The reason I'm putting this up here is we put aside 20 minutes to do this. Yeah, on the Fox logo, I took some liberties and put some like Sense colors inside of it. Sorry.
It looks really pretty, actually. It looks good.
Thanks, man. It goes well together. But I put this up because we only have 20 minutes to present, but we're going to touch on a lot of concepts that I'm not going to go on too deeply. Like some people already understand some of these, some people don't already understand some of these. If you have questions or anything afterward, we'll have some Q&A, but also follow up with me. I can talk about many subsets of what we're going to touch on for hours, and it's my favorite thing to do. So this brings me to a thing. I'm going to structure this interestingly. I'm going to start with kind of some principles around DAO treasury management that we came up with. I think that frames sort of why DUX works the way it does. And then we're going to go into what DUX actually is, and then some kind of core concepts of what Sense does on the back end for that, which we'll try to do quickly. And then some actual examples of working with some numbers that are from estimates I got from John, as well as just stuff I could look up about your guys' treasury allocation. So the first thing we'll talk about is what is good DAO financing. And the reason I'm talking about this is that a DAO is not a hedge fund. It exists for totally different purposes. And so it should manage its treasury towards different kinds of goals than just maximizing returns. Specifically, more like, say, a pension fund, a DAO, and I know every DAO is a snowflake, but a DAO like ShapeShift that is like paying for ops expenses and that kind of thing. A DAO's primary goal is to be able to pay for expenses, some known liabilities in the future, and to be able to continue to pay those expenses for as long as possible going further into the future. So this kind of leads us to a few basic principles that we can approach DAO management with. The first one is asset liability matching. You have some set number of liabilities you have in the future. You want to make sure you have the right amount of cash in the right denomination to meet those liabilities. And in order to continue being able to do so as far into the future as possible, you want to avoid at all costs selling down your principal. Principal protection is a thing here. You have this nest egg of capital that you want to use to meet your liabilities, ideally in a way that is long-term sustainable, which means protecting the principal, ideally growing it slowly over time. But if you're in a situation where you are meeting all of your liabilities and your principal is just staying the same, that is perfect management, right? If you can also grow your principal, that's great, but you don't want to take risks of missing liabilities or losing principal in order to have more access to upside on the principal. The purpose of it is to do the liability matching. And last, this is a little bit different from, say, sovereign wealth funds, pension funds, corporate treasuries, other kind of comparable treasury management situations, which is that sorry, I'm getting distracted by the chat for a second, which is that a DAO is inherently sort of tied in with this big group of stakeholders, which are the community. And particularly in one like ShapeShift's case, where you primarily hold your native token, your community can suffer a lot of negative externalities from different kinds of financing options you would do or different kinds of treasury management you would do. So you want to make sure that you maintain community favorability as a core principle of any financing options and like treasury allocation choices that you make. Now, looking at these kind of three principles of goals we have versus some of the existing options, they're not so great. And a lot of people are kind of working on this right now. And there's a lot of new things that people are, putting together for DAO financing options. But dumping spot, obviously, is a way to asset liability match. You could sell enough to pay for, you could sell enough Fox to USDC to pay for all your liabilities for the year. Solid asset liability matching. Obviously, every time you're doing that, you're wounding your principal. Every time you're doing that, you're diminishing your ability to pay future liabilities with a nest egg of capital. And obviously, communities don't love it if you're just dumping on spot markets because a lot of them have a financial exposure to the token that you are creating sell pressure for. And then one way to avoid that last thing is to do a VC sale, which again gets your asset liability matching, but also, again, is losing a big chunk of your principal and is not community favorable because even if you're avoiding dumping on spot markets with lockups, you are literally offering a third party better terms than your community can get for access to the token. And then lastly, there is the just borrowing against the capital option, collateralizing your native token, borrowing USDC, which seems like it's asset liability matching in that you get, the right asset and the right denomination to pay the bills. But it's actually not, because then you're creating a cost of capital cost that is a different denomination than what you're using to pay it. So you don't know what you're going to have to sell in order to pay interest payments. But also, potentially, if you can't infinitely roll over the debt, you are creating a need at some point to pay back that principal loan amount by selling a chunk of your treasury, which would, both of those things, the cost of capital and the potentially having to not continue revolving that debt, put your principal at risk. Plus, also, obviously, if you're collateralizing your principal, collateral can be taken in the right market conditions. And this can or can't be community favorable. Obviously, if you're borrowing directly or indirectly through a service from your community, you can be offering them favorable terms, or you could be borrowing from another person, in which case it is, kind of neutral to the community. And the whole point of DUX is to nail all three of these things and to get rid of compromises. It's a little bit more custom to how DAOs work and less just porting over a concept from different kinds of treasury entities. Which obviously begs the question, what is a DUX? Some of you, if you are familiar with some of these concepts, this will be really easy to understand. It's a lot like doing what Pipe does for startups by putting up capital for a portion of their future revenue, but for yield on DAO treasury assets. And instead of Pipe, it would be the community putting up the capital. We'll go into detail of how this actually works because I think that's exactly why I'm going to have to explain some concepts that some people will already know and some people won't. So I'll try to do it in an efficient way. Basically, a DUX is this. You will take some chunk of your Fox and put it into Foxy. I'm using Foxy as an example. You could do this with any yield-bearing asset in your treasury. Then you're going to use the contract since as deployed to separate that Foxy into future yield between now and some period and some time in the future, and principal now and some time in the future. Principal is the initial amount of capital you start with. And what you'll do is take a maturity date, create a claim to get that principal amount in Fox terms. So you'll get the same equivalent Fox amount of Foxy at the end, and then create a separate token that will pay to its holder any yield accrued between now and that endpoint. It could be 12 months from now, it could be 24 months from now. All of that is stuff that we'll talk about in a second. Then you're going to take that yield and sell it to the community at a discount to its current expected market value, based on current prices and based on some expected amount of yield, although the yield is variable. So they're going to take some risk on not knowing what the yield's going to be, but based on current market expectations, you will sell it to them at a discount to its EV, which gives them a positive EV. And it gives you capital now, which brings me to kind of the outcome of this entire transaction, which is the DAO gets immediate cash up front in the denomination of its choosing. I'm presuming you'll want stable coins, but it could be, DAI, USDC, whatever. You could do it for ETH if you wanted to, up to you. Two is perfect asset liability matching. I say this in the sense that like you could start by just saying how much capital do we need, and I actually think you guys have enough that if you're willing to lock up for a long enough period or enough of your Foxy, you will just be able to finance all your expenses. And the cool part about the perfect ALM is that there is no cost of capital that has any market risk or mismatch against what you're holding. The cost of capital is whatever the yield turns out to be. So you have this sort of unknown future income stream, which is the yield, and your cost of capital is just equal to that. So you have asset liability matching on that side, the cost of capital, as well as asset liability matching for your liabilities that you're raising money to pay. Next is principal protected, because what you're doing is you're splitting this principal from the yield tokens, selling the yield tokens, and at the end of the maturity of the series, what we call it, that you create, your principal will be redeemable for an amount of Foxy equivalent to your starting amount of Fox. So you will end up with the same Fox holding that you have now at the end of this period, simply like mechanistically based on how it works. Your community gets a good deal. Obviously, how good the deal is for the community depends on the number of months you're selling, how much money you're raising, whatever. But a big principle of this is to do it at a discount to what you think the value would be, such that they are buying it with a positive expected return, and they're getting discounted access to tokens, and they're getting them in the future. So you don't have that kind of immediate sell pressure that you would have in some other situations. Lastly, these are kind of, I'm going to combine, it's repeatable, permissionless, and flexible. You can do this for any amount, for any duration, as often as you want, raising whatever asset you want, and you don't have to do it through us. Like, I'm here to explain this, to talk to you about it, answer questions, but if you build an adapter to make Foxy attached to the system, you can literally just like do it whenever. You can do it as an experiment for a small amount and be like, that worked, and then do more. Whatever you want. You can create a schedule of all the times you're going to do it in the future, whatever. And it's 100% on chain. So there's no negotiation with like a third party entity, whether it's like a VC or like a loan originator. And there's no kind of weird, on chain to meet space oracles. Like this is all in contracts. So this is the part where I think some people I know John's already familiar with the stuff. Some of you probably are. I want to talk about how Sense protocol works, which is kind of going to be the back end of splitting that yield from the principal. I'm going to do this very briefly. To get to the actual examples of what it would be like for ShapeShift. So high level conceptual point, every yield bearing asset is basically the same thing. In this case, we'll take Fox and Foxy. If I take one Fox and I convert it into Foxy, that one Fox going out is the investment bar on this chart. And I'm committing that at 12 months, I'm going to take out the Foxy and convert it back to Fox. I know I will have that one Fox at the end because Foxy is just going to be accruing yield on top of some amount of principal I put in. So that principal amount is going to equal to my initial investment. I'm saying I'm going to take the one Foxy out. And I'm also going to get every piece of yield that happens in between, which is a bunch of small variable payments between now and that end state. So we have this set of unknown yield payments of unknown size. And then we have this, for sure, because we decided we're going to take it out, principal reclaimed into Foxy or into Fox at the end, which is a known amount because it's equal to whatever we started with in Fox terms. All Sense does is separate these two things into two tokens. It's a contract that will do the accounting to make sure whoever holds the yield token gets paid out all the yield that accrues, and that whoever holds the principal token after the maturity, meaning after it's no longer paying out yield to the yield token holder, can go and claim the initial principal amount that was deposited into it. As like a basic example, if we were doing this with Foxy, this is just like a different way of visualizing it. And the left is today, the right end of the chart is 12 months from now at maturity. The principal amount is the dark blue square, which would just be in the contract until this ShapeShift came and reclaimed it at the end. And the accruing value of the yield is this growing lighter blue triangle on top, which would be accrued to the community who would be holding the yield tokens. And they can transfer those and it'll accrue up to the point they transfer, et cetera, et cetera. Okay, so concepts, I think, have been communicated. Now we can talk about actual examples for ShapeShift. So there's kind of three tools you can use to manipulate how this looks. You can do a larger amount of Foxy to start with. So you're selling yield from a larger base of principal, which means a larger amount of yield, which means that if you had the same duration at the same total price of what you're raising from the community, it would be a better deal the more yield it is for them. So a larger discount. There's duration, which is just the number of months.
Mr. If I could just interject with a really quick clarifying question. When you say how much Foxy will you strip and sell yield from, are you talking about the amount of Fox that the DAO would put into the Foxy contract and then in turn put into the Sense protocol?
Yes.
Okay, thank you.
And then the next thing is duration, which is just the number of months of yield payments that the community will get, and also the number of months until the PT, which is the principal token that the treasury holds, will be redeemable for the principal, which is being held in the contract. And the duration is, the whole thing is very sensitive to duration, actually. Because the yield's getting paid out in a yield-bearing token, Foxy in this case, there is yield accrued on the yield. And so there's a non-linearity to how good of a deal a community gets or how much money you can raise at the same goodness of deal or like the same discount for the community as duration goes up. So that's my favorite tool to play with on this. And lastly is the amount raised. If you're going to, lock up the same amount of Foxy for the same number of months, if you're charging more, the community is getting a smaller discount. So if you're raising more, the community is getting a smaller discount. If you raise less on the same base, the community gets a better discount, obviously. So I kind of worked up 3 examples here. We have analytics for all of these, and I also have a very dynamic model that will allow us to very quickly check out any kind of situations you guys want to come up with. But I just wanted to come up with some sort of to give a flavor examples. And this is all assuming a 10% yield on Foxy, and to do the discounting, it's assuming flat prices. So they're getting a discounted access to future tokens at current token prices. So the simple case, if you locked up $40 million for 12 months with a 10% yield, you could raise $3 million by selling just that yield to the community at a 25% discount, which would, the inverse of that would be a 30% expected return. If you crank up the duration on that to 24 months, now we can raise the same amount of money, $3 million, with a bigger discount, a 29% discount for the community, which is about a 40% return, or EV return, and only use $20 million of capital to begin with. And lastly, you could just give the community a smaller discount. So if we only do a 10% discount, but we start at the 12 months and the same amount of money raised, we can achieve that with $33 million. Now, I want to go through a couple charts here. I have more analytics for all these, but I want it to be not too analytics heavy and more idea heavy on this. Here's the basic picture of the transaction in the first example. The base case, the DAO gets $3 million up front. That's your green bar here. The community is paying out that $3 million that's going to the DAO. And then the main cash flow after that is these yield payments going to the community. To break down the community's return profile here, this chart's going to be a little bit overwhelming for a second, but it's actually not too crazy. These are just cumulative inflows and outflows. So obviously the community starts at cost. They pay the $3 million. Their P&L at 0.0 is negative $3 million. That cost is flat. They aren't incurring any more costs over time. This is just showing the impact on the purple dotted line, their P&L over time, as they cumulatively accrue more yield and as that yield accrues yield. That had to be factored in too. It's not a huge impact on this one. When you get into longer durations, that can be really impactful. So we really had to include it in the chart. And they basically end up, with a $3 million investment making a $1 million return on top of recouping. So that's where your 30% positive EV comes from, which is equivalent to buying at 25% discount. And this one's a little conceptual too. Obviously, the main flow for the DAO is going to be the funding that they're getting in USDC. And at the end state, they're getting back their principal. So they're going to end up with what they started with plus the funding. So you can mess with all these numbers. At the end of this chart, the purple dotted line always goes to, funding, 0 plus funding. What I'm doing here with the negative impact is that if you create a secondary market for this, which you can, and you can provide liquidity for it, and we're assuming that this 10% true yield is what's implied in the market, then the PT, the future claim, would trade at a discount, and that discount would go to 0 over, as it approached maturity. And then it would obviously, the value of the PT, which is redeemable for the principal, is equal to the principal at the point it can be redeemed. So there will always be a, discount in a mark-to-market sense. And then that discount will always go to 0 as you get to maturity. And so next steps for us here would be talk to technical folks, because we do need to build an adapter for Foxy, then connect to treasury management to go over, we can give you guys some more analytics and thoughts on exactly what terms sort of you would use for this, and then move forward in governance. I don't really know exactly your governance process. And with all this, I wanted to save time, which I hopefully did. I feel like I actually did this faster than I expected to for Q&A. And some potential, juicy areas for queues are One, the Sense protocol will automatically create a spaceful AMM, which is our very, very fun and sexy AMM for trading these kinds of assets. And ShapeShiftDAO could be an LP for that if they want to have the community be able to exit the position if they wanted to. And doing so would also, as a sort of bonus thing, would create a yield market for Foxy, which would also create a fixed income equivalent of Foxy, which would be SP Foxy, which creates a situation also where in the future you could either sell at a discount to the priced in yield of where this market is, or you could just sell directly into the market and you'd compress yields and it would just be profitable if people take the other side of the trade. That's a little more complicated transaction. We can talk about that separately. And lastly, I have a dynamic model for these. We can run any kind of inputs that you guys are curious about. And I also have a bunch of like more charts in the addendum to explain concepts as well as to go through some more of these cases in detail and talk about duration and financing amount sensitivity. And lastly, I want to leave you guys with this. You can check out Sense. Go check out the Sense Discord. Maybe we can put a link in here. But yeah, I think that's about it. So any questions?
Great deck and great presentation. That was awesome. Before I forget, would it be possible for you to drop a link to this deck in the stage chat?
Yeah, I think that's fine.
Perfect. Because that was really informative. And you read my mind there at the end in terms of all the fun stuff you can do when you actually have liquid yield tokens. It just introduces this whole new dynamic and all sorts of fun stuff.
Yeah. It's interesting because you guys are really more advanced than a couple of folks that we've talked to in terms of treasury management concepts. In this case, we're talking about the treasury management benefits, which I think is actually the coolest thing about it. But this kind of also token utility that gets created by having a yield market for these things. Whereas I think that for a lot of people, their interest in this is going to start with token utility and be like token utility in the front, treasury management or treasury financing in the back. This is kind of the other way around.
Nice DeFi mullet there.
Yeah.
So, and then thanks again for really taking the time to understand kind of where we're coming from. You're really, articulating a lot of our pain points in terms of wanting to, diversify our treasury and all those different trade-offs. If you don't mind, I have some questions, and then I see Willie up on stage, and I'm sure the community has questions as well. The yield in this product is generated from the fact that the Foxy itself is generating yield. Of course, that's the raison d'etre of Foxy. How do you handle how do you handle the fact that Foxy itself could be variable yield over time? So, you're talking about that 10% yield averaged out, but what happens when Foxy itself is yielding a variable rate?
Well, that's exactly kind of the point of this transaction, which is to my beginning point. The point of a DAO is not to optimize Sharpe ratios. Your community is probably looking to optimize return, which is why you would sell at a discount to expected value. You're offloading that risk. The community is taking the risk of what the variable yield from this will be. The end state construction that you're doing, although the denominations are different, is you're taking your treasury principal plus a fixed amount of USDC yield. And you're doing that at a lower rate than what the actual expected USDC value of the will be variable Foxy yield is in order to incentivize your community to hold the risk of the variability of that yield, as well as the variability of the underlying token itself versus, real human life liabilities. So the holders of the YTs will get whatever the yield turns out to be, or whatever those payments turned out to be in a way that is much more capital efficient for them than going and holding a bunch of Foxy. They are getting, in this case, $40 million worth of Foxy yield with $3 million all in.
That makes sense. And then one might anticipate that the price of those tokens, if we did have the open liquid market for these tokens, would fluctuate in tandem with the variable rate of Foxy.
Yes. So, or actually in a way that's pricing in the expected future variable rate, where if you have 1 month until the maturity of an asset, the priced in implied rate is what people think the average rate should be over that month. Oftentimes, actually, in traditional markets, because the interesting thing about this, one of the reasons I think other people who are doing yield stripping have not met with much product market fit is that these kinds of markets rely on there being a purchaser of fixed yields. there's a or like a large purchase or fixed yield. It takes very little purchasing of variable yield to offset a large amount of fixed yield. And the missing interesting thing here is that when you separate yield from principal in risk terms, you're also separating them in denomination terms. What you're doing is you're selling a variable Fox yield and getting for it a yield in USDC. I think that the demand that like DAOs have both a demand for known yields in USDC that is less than the EV of the yields of their treasuries, but is fixed, and they know they can use a plan and like match liabilities. And they have a group of people who don't want them to sell things on spot, which is the community, but do want large positive returns, and so we'll buy those yields at a discounted price that makes them very attractive.
Cool, that makes sense. So this is a clever bit of financial engineering here that really speaks to the needs of DAOs. Is Sense currently live? And if not, when will you guys go into production?
We're live on mainnet right now. We went live about a month ago only. Cool. So we have some guarded launch caps that are actually coming off in the next week or so.
Okay. And in terms of audits, well, what do you guys have there?
Sounds like a Josh question. I know Josh is in here. Also, our CTO is here, so he's going to have answers to some questions that don't have answers. And also, don't be afraid to get super technical with him.
Cool.
Josh? I saw him messaging in here before.
In lieu of that, if he's not available, just a link to any audits you guys have done would be helpful as well. Yeah, how's it going a month in? Is it kind of fairly smooth and what you guys hoped for?
Josh just posted the audits in here.
Oh, thank you, Josh.
Yeah, I think that like a month in is one of those things where you kind of expect things some things are going to go horribly wrong when you first go live. And like, things are going to break. They don't expect you, no matter how many audits you do and stuff. And there have been some like things kind of broke, but all pretty minor. You know what I mean? Like the things that went wrong were the best things you could hope for. Nothing that put like funds at risk or anything like that. It was all just kind of like, oh, like that's weird. Let's fix that.
Cool. Yeah, that's a good place to be. And then lastly, before I turn it over to everybody else, I assume this is just the plans are to have this on ETH mainnet initially, and because I mean, from the standpoint of the DAO, we're not looking at making tons of transactions. Of course, the users themselves would be buying these yield tokens. Do you guys have any scalability or scaling plans looking further out, like in terms of rollups?
I think there is obviously. It will be, I think, expected that all things exist on L2s before too long. We don't have anything specific of like we're already building to deploy to a specific L2 or anything. Cool.
Yeah, I think the nature of what you guys are doing is mainnet. It should be sufficient for a while. Certainly no blockers there. Well, thanks for the answers. We have Willie up on stage. Hey, Willie.
GM, everybody. Thanks, Mister, for the excellent presentation.
Sure.
I wanted to ask what discount you guys are seeing right now with the current month into this that kind of the market is demanding for.
So we have
the variable yield.
Yes, so we've done yield stripping for WST ETH and USDC adapters only, where you can just go and strip the yield and sell it into a live market. We have not done a DAO transaction like this, although this is where I think is the actual product market fit for us. There are people who have, there are a few, principal yield, like IOPO style. It's like interest only, principal only style stripping protocols that are retail people. But I think that like most degens are like not that psyched about 4% yield. I think that DAOs could be psyched on 4% USDC denominated yields paid up front on their treasuries. So like I think that this is where I am thinking we're going to focus a lot of our effort is transactions like this, but we haven't done one with a DAO yet. You were the first people we're presenting this to.
Cool. Well,
we've spoken to this in private with a couple protocols in DAOs, but we haven't actually done this in like a public, open to the public conversation yet.
Cool. Well, happy to be the first, and I'm open to the experiment. But I will say, the reason my skepticism comes from the fact that right now at the DAO we do have the ability to basically stream tokens over any period of time we want, and we're doing that right now with programs like the Olympus bonds, and we're already having to pay or offer a discount just for the time trade-off of having to hold these tokens because these tokens are volatile. And I'm curious what additional discount we'd have to offer if we're also offering variable yield. And I could definitely see that being valuable at a point when we have all of our assets in the treasury are being put to work to generate yield. But right now, we already have a lot of Fox that's otherwise sitting idly, basically, and we can. I don't know if the benefit is worth it. I'm curious what that discount that the market will demand will be for taking on that variable yield risk. I'm curious if that will be worth it to the DAO.
I think there are also interesting follow-up conversations to have on like details of how one of these can work. And I can even run some numbers. Like I have a reasonably pretty workable model we could put some inputs into. But you can also do a pretty small pilot program with this. And something I think is kind of cool, like one of the things I want to make is like a 100-year ETH bond. It's like you could do with a pretty small amount of starting capital, like a 5-year bond, and then like see if people are interested in buying that, and then make it liquidly tradable. So like they can exit if they want to.
Cool. So to that point, what are our options if we do an experiment with this and we dedicate some Foxy to it, and let's say like the discount gets higher than we're willing to accept, or none of it gets purchased? Is there the ability for the DAO to recoup its funds before the end of the bond?
So one of the interesting things about it, so as I said, there can be a secondary market for it. The secondary market, the principal token will always trade at a discount to the principal it can claim up until the point you can claim it. The reason this is true is because there is also a dollar value. Actually, you know what? Maybe I can bring this up on the same thing. Well, whatever. Is that there's the dollar value to that yield token too, and you can liquidly redeem yield and principal back for the original at all times. So the principal becomes redeemable 1-to-1 for the principal. But if you go mint principal and yield, and you have equal amounts of principal and yield, you can go use those to redeem for the underlying also. Or what we could call it the target, is redeem for the target asset. So if you sold half of your yield tokens, you could take the other half of your yield tokens and redeem it with half your principal to get the initial capital back out.
Cool. And can you talk more about some of the other benefits you see beyond like DAO treasury management? If we were to launch this Foxy yieldy kind of variable yield option, I'm curious about kind of the other benefits that might come from this, because I think that could be even more interesting in the near term than the DAO treasury management aspect to me.
Yeah. So what you create is a market for buying just yield tokens. People can buy simply variable future yield streams of Fox, or of Foxy rather, and then also because the principal tokens are claimable, each of those principal tokens is a claim to a certain amount of Foxy at a certain time in the future at maturity. So you can create not only a fixed rate market, so it prices in what people think the expected return of the Foxy will be, but you can also create a whole yield curve. Like you can have series exist at 3 months, 6 month, 1 year, 5 year, 10 year, and have like a yield curve of priced in future Foxy returns.
Cool. And theoretically, we could give users the option to choose between like variable yield on their Foxy or fixed yield in USDC. Yeah. That's pretty cool.
Yeah, and there's other things that, like I was saying before, is that one of the things people miss about this is that also separating principal and yield in return terms or in payment terms is the same thing as separating them in denomination terms, where to the degree you guys have these other assets, they're also going to be yield bearing. I know there's on a different chain or something. It's like I heard a bit of a conversation before, is like people can compose their own exposure where they're going to buy, like they convert their principal into one thing and then buy yield from something else.
Cool. Yeah, looking forward to playing with the models, and I'm open to the experiment. If we were to be the first DAO, would there be any kind of special benefits for ShapeShift for being the guinea pig for this?
Well, I don't know what they'd be on top of my head, but it'd be pretty cool. So I'm happy. I can show you this model real quick if you guys want to take a peek at it. This was a very fun week for me to put together. I used to work at a hedge fund back in the day, and Excel is my home. So this is our model, where to take an example, if you go like $5 million, wait, can you see this? Is this sharing successfully?
Yeah, we can see. It's in the same if anyone wants to follow.
If you took just $5 million at 5-year bond, you can raise 5 million. So sorry, just a quick thing here. These are your inputs, and the percent financing is how much you're raising as a percent of the capital that you're committing, which is 5 million, not 5. So like you could raise $1 million on a 5-year bond if the expected return is 10%. and your community is buying at a 6-7% discount, so like expected 3x at current prices, at current expected yield, which is like pretty capital efficient. If there's people who want to be getting streams of Foxy for 5 years, and then so we can run through any examples you want to do with this. We can fool around. It gives you a sense of what the sensitivity to changing duration is over here, what these charts are, as well as the sensitivity to changing how much money you're raising. And these are different ways of breaking down those return profiles that I kind of showed you before. Yeah.
Cool. Yeah, I think my main concern or like skepticism is that there will be sufficient demand for this type of variable discount on such a long time frame, or if there is, like what discount we will need to offer to raise funds.
Yeah.
But if that does get solved, then I think it's definitely like an interesting experiment, and it does solve some of our pressing needs. And on the bright side, it does seem like the downside of taking part in this experiment is little to none. So worst case, we end up recouping our initial Fox deposit.
My from the hip stuff on this is that if you make it a really aggressive 3x EV and you're creating a secondary market for it, I personally would buy, if I had like a desire to have Foxy exposure, as much of that as you would still. And I think that probably you could do is have a window where you have a whitelisted community sale, and then after which you can open it to the public and even see if funds want to backfill it, because I think funds would buy that, to be honest. But make sure you give the offer to your community first, and if they turn it down, then you can sell it to institutions. But I think that I would rather, and I think it's better for DAOs to sell it to the community. I think funds would buy this.
Cool. That would be great if so. So that's all my questions for now. Thanks for the great answers, Mister.
Thanks, Willie. Awesome questions. Who else has questions here? We still have 7 minutes in the stage chat, or if anybody, hey, it's Josh.
Hey, I actually don't have any questions because that was so thorough, and you and Willie pretty much covered them. So I think this is really just a matter for the TMDC to take and decide if we want and what parameters we want. Are these spreadsheets or a simple spreadsheet, Mister, available that you can share with us that we could, put our own numbers in and move around?
Yeah, I can. It's in Excel. If you try to do it without Excel on like a Mac or in Google Sheets, it will break. Any people who have a PC and use Excel, I'm sorry. I know it's like super like 90s of me, but that's just like it's 10 times faster for me to do it that way than to try to do it in Google Sheets.
Very hedge fundy.
I'm happy to spend time with you guys doing it, and we're working with it with you. I'm also happy to send it over if you have somebody who can use it. But don't pick up the question for me if I'm not sure exactly what next steps are for this.
Yeah, right. I think we need to talk to figure out the next steps. But here's John too. You might have some more follow-up.
Oh, quick question. Also, was this recorded?
Yes, this will be on our Twitch stream, unless we had a rare malfunction. I think GK could probably confirm. But all of our workstream calls, including this one, wind up on Twitch. Yes, great. Twitch and YouTube. So it will be recorded for posterity.
Okay, I'll just send it over to our team as well, so that I can take notes on all this stuff that I'm not really taking notes on right now.
Yeah, I just wanted thank you, Mister, for the super thorough presentation. When I first talked with you guys, I was definitely excited about the opportunities for this, and I definitely think it's worth us considering.
Thanks for inviting us.
Yeah, maybe at least experimenting with. And you guys have been super awesome and responsive in terms of chatting with us over the last week and this presentation today. I think for the community and the TMDC and others that may be interested in this, I think what we'll need to consider long term, I think some small amount of this we could probably do pretty easily. I think the big thing for us, and I think Willie was getting at this, is just going to be the opportunity cost of the capital that we have to consider. So like, for example, right now we could take that same Foxy and we can borrow against it, or at least we could have before Rari got exploited and borrowing was paused.
Last week,
at some point we will be able to do that. So there's some amount of efficiency loss when we basically lock up all the principal.
Quick note on that. We have our own fuse pool. So if people were to put capital into that fuse pool, you'd be able to borrow against your principal claim tokens as well.
Ooh, well, that's good to know actually, and that also means we could also put the principal token up in our fuse pool too. But
Yeah.
that's great if it's in
And
yours.
also, if you did want secondary market and you provided liquidity for that in our space pool, our space AMM, the LP tokens for our space AMM will also be able to be used as collateral in our fuse pool.
And that also means the yield token themselves could also be collateral or whatnot, right?
Principal tokens, I don't think the yield tokens can. Because those are things that will go to zero over time, because as you hit maturity, the yield tokens are claimed to zero future yield payments, so their value is zero. So they don't work
Okay,
as collateral.
that's a great
the principal
point.
tokens do.
That's a great point because it dramatically increases the capital efficiency if the DAO can basically separate out the yield, sell the yield, basically get some cash up front, and then also still borrow against its principal token while it's vesting more or less. That gives it the ability to be a lot more capital efficient, which otherwise it'd be giving up. So that's great. That's good to know, and that's something we can consider.
Yeah. I mean, to be clear, our fuse pool is basically empty right now because we launched a month ago and we paused it with all the stuff going on. But if you were to go provide some collateral there, people would start lending against it, I think, pretty quickly.
Hey, so question about that. So if we put that principal token right up as collateral and borrowed against it, just thinking about like for that to be viable, you'd want it to be able to be liquid so that, if something hit that a liquidation bot could then manage that. I mean, we would watch it, but I mean, for it to really function well. So does that mean there's also a liquidity pool with the principal token that you create too?
That's the space pool AMM that I was talking about, which you guys could be liquidity providers for. If you're the only issuer and you aren't providing liquidity, there can't really be liquidity for it unless somebody else goes and issues on the same series. But what you could do is issue and then also be an LP such that that is liquid, your PT, and other people, and you could allow other people to issue on the same series if you wanted to as well. So there could be other LPs, but also that would allow people holding the YTs to sell them back into the pool.
So we would have to, if we're the only holder of the principal token, we're going to have to provide liquidity with some of them, and then we can use so that's not as capital efficient, but we can then with whatever we have left, we can put up as collateral in a Rari pool and borrow against it.
Yeah, I think that the end state of this, if you guys use this as a regular funding method, is actually there exist adapters and series that other people can also issue on across a yield curve. And you guys occasionally go issue a large amount and then sell the YTs, the yield token claims, at below market for the existing traded market of, 5-year Foxy or 1-year Foxy or whatever. Such that when you do this, you create a downward pressure on the priced in fixed income, but in a way that you're still getting plenty of return in USDC terms to cover your liabilities. And the downward pressure on the fixed income pricing means that the YT purchase is more attractive, where you are buying a YT that you actually expect to pay, say, 10% at a price that implies that it would pay for, or that it would pay for, or whatever it would be. I think that there's like the in-between world where you're the only LP and the only issuer, I think is like not really the end state here. I think there's like a starting state where you're the only issuer and you're the only LP as like a pilot, and then you actually